Okay, welcome to the Deep Dive with TalkTickers. We're here to unpack the key discussions shaping the market.
That's right.
And today we're zeroing in on Credicorp, specifically their recent conference call about Q1 2025 performance.
Yep.
Our goal, as always, is to cut through all the noise, give you the really critical insights from that call, so you walk away knowing where they stand, what they're seeing.
Exactly. We've listened to the company's own words, their discussion. We're pulling out the signals on performance, the economic environment, the outlook, getting the story straight from them.
Okay, so let's start where they did, the big numbers, the headlines they really wanted to push for Q1. What was that top line message?
Well, the main figure they reported was a return on equity, ROE, of 20.3% for the quarter.
20.3%.
Yeah. And ROE, that's a core profitability metric. It basically tells you how much profit they're making with shareholder money. So 20.3 sounds, well, pretty good.
It does sound healthy, but was there more to it? Was that the whole story?
Not quite. They were quick to add context. That 20.3%, it included a one-off gain, an extraordinary item from fully acquiring a joint venture.
Ah, okay. Like finding some extra cash you forgot about. Nice, but not repeatable.
Exactly. So if you strip that out, the operating ROE, the profit from their actual day-to-day business was 18.4%.
Right, 18.4%. That's the core number then. And how did they frame that figure?
They really highlighted that this adjusted ROE, the 18.4%, still beat their own expectations.
Oh, interesting.
Yeah, they saw it reflecting, strong fundamentals across their main businesses. So even without the one-off boost, the core operation delivered better than they thought. The key takeaway really is operationally a solid first quarter.
Got it. Strong core performance, better than expected, even without the special item. Good starting point. Okay, let's zoom out. The bigger picture. How did they describe the economy they're working in? Especially Peru, that's a massive market for them, right?
Right. And this is where it gets, well, pretty interesting. A real contrast. When talking about Peru's domestic economy, they sounded quite confident. Actually, notably confident.
Okay.
They think it's bouncing back faster than they previously anticipated.
Faster. What signs are they seeing? What's backing that up?
Several things. First, Peru's GDP grew 3.9% in Q1 compared to last year.
Okay.
And importantly, this is the third quarter in a row with growth around that level. Almost 4% for 3 straight quarters. That signals real momentum.
3 quarters. Yeah, that's definitely a trend, not just a blip. What's behind that momentum?
They mentioned momentum across different sectors, construction, retail, agriculture, services. They're seeing higher expectations for private investment, a recovery in formal jobs.
Right, stable jobs returning.
Exactly. And interest rates are coming down, which usually spurs borrowing, stimulates credit demand. Plus, inflation's low, just 1.7% in April.
Keeps purchasing power stable.
Yep. And record terms of trade. That's the ratio export prices to import prices, boosted by high commodity prices like gold and copper, which Peru exports a lot of.
So a lot of positive signals domestically in Peru. Did they touch on the political side? Peru's had some volatility there.
They did acknowledge, some lingering political uncertainty, but their view was that the overall macroeconomic management, how the government's handling the economy, has stayed broadly responsible, kind of despite the political noise.
Okay.
They even hinted that a bit more political stability could actually unlock even more economic upside.
Right. So the domestic scene looking pretty robust from their viewpoint, but obviously no economy is an island. What about the global picture? How did they see that?
And here the tone really shifted, much more cautious. They emphasized the global environment remains uncertain. One specific worry they flagged was potential new U.S. tariffs. They mentioned a possible 10% tariff on imports from all trading partners.
A 10% blanket tariff. How would that hit Peru or Credicorp?
Well, their direct analysis suggested the immediate hit to Peru's overall GDP might be limited.
Yeah.
But the bigger worry is the knock-on effect, how global trade tensions could slow down overall global growth and what that does to commodity prices.
Right, because Peru is a small, open economy, heavily reliant on trade, especially with China and the U.S., buying their commodities like copper.
Precisely.
Yeah.
So it's less about a direct tariff on Peruvian goods, maybe, and more about the ripple effect. If global demand for copper drops because of trade wars, that hits Peru indirectly.
Got it. Makes sense.
They said it's still early days to fully assess the impact, but it's definitely on their radar. They're monitoring it closely.
Any glimmers of hope on the global front? Any counterpoints?
Yeah, they did mention some positives. Recent progress in trade talks, U.S.-China, U.S.-UK. They see those as encouraging signs. maybe lessening some of those risks to global growth.
Okay. And quickly, any mention of the rest of the region? Chile, Colombia.
Briefly, Chile, they noted, could face challenges tied to copper prices and business confidence from external factors. Colombia, potential pressure on government revenue if oil prices fall. But interestingly, they also floated the idea that longer-term shifts in global trade could actually create opportunities for places like Peru, Colombia, Chile. Sort of a potential silver lining down the road.
Okay, so the macro picture is this. Strong domestic recovery in Peru, looking good, but shadowed by this cloud of global uncertainty, especially around trade and commodities. That's the tension.
Exactly. That's the balancing act they described. Domestic optimism versus external caution.
All right, let's drill down now into the company itself. Beyond the headlines, beyond the macro, how are they actually performing within this environment? What operational details did they share?
Okay, first up, loans. Their loan book.
Yeah.
They saw growth resuming in average daily balances, up 1.5% year over year in Q1.
1.5%. Where did that growth come from initially?
Mostly wholesale banking lending to big companies and also individual consumer lending. But they expect growth to pick up in their SME, small business and microfinance areas later in the year.
Okay. They also mentioned something about Bolivia, an accounting adjustment.
Yeah, it's important to note this was just accounting, not business operations shrinking. They have operations in Bolivia, and because the exchange rate there changed significantly, they had to revalue their Bolivian assets using a more current rate.
Right.
So on paper, their total reported assets went down about 2%, purely because of that currency revaluation, not because the underlying business changed.
Got it. An accounting quirk, not a fundamental shift. What about loan quality? Are people paying back their loans better?
Yes, definitely. They highlighted a material, meaning significant improvement in asset quality compared to last year.
Okay.
Non-performing loans, NPLs, those loans that are way overdue, they contracted, meaning they went down, across BCP, their main bank, and Mabanko, the microfinance arm. The overall NPL ratio for the whole company was 5.1%.
So, fewer bad loans. How did that translate into their cost of risk, the money they set aside for potential losses?
That fell quite a bit, down to a low of 1.6%.
Wow, 1.6%.
Yeah, they put it down to a few things. Better management of their loan portfolios, customers just paying better, the improving Peruvian economy helping borrowers, obviously, and crucially, proactive steps they've taken since 2023.
Like what?
Things like tightening their underwriting standards, being more careful who they lend to, repricing risk better, using more advanced analytics. They also mentioned a bigger risk transformation project that they expect will have an even bigger impact starting in 2026.
Okay, so it's a mix. The economy's helping, but their own actions are really driving down those potential losses too. What about profit margins on lending? Their net interest margin, NIM, did that hold up?
It did. Remain resilient, they said, at 6.2%. It actually strengthened a little bit compared to the previous quarter.
How come if overall rates might be falling?
A big factor is their growing base of low-cost deposits. Those now make up 59% of their total funding. So even if market rates dip, having a large chunk of cheap funding helps protect their lending margins.
That deposit growth sounds key then.
Absolutely. They said it's driven by more confidence in the banking system generally, plus their own investments in service and digital platforms, making people want to bank with them. And it's paying off they gain market share in those valuable low-cost deposits.
Were they making money elsewhere besides just interest on loans?
Yes, they highlighted strong double-digit growth year over year in what they call non-interest income.
Okay, like fees.
Exactly. Fee income was up 16%, driven by lots of activity on their digital platform YAPE and at BCP. Gains from foreign exchange trading were up over 12%. And their insurance underwriting results, the profit from insurance policies, also strong, up nearly 18%. So diversification efforts seem to be working.
And efficiency. How much does it cost them to run the business? Did they mention the efficiency ratio?
Yep, 45.7% for the quarter. They said that's within their expected range. It reflects strategic investments they're making in things like innovation and digital, which they see driving both growth and eventually more efficiency.
Right. And finally, sustainability. Is that still a major focus?
Definitely. They framed it as deeply embedded in their 2025-2030 strategy, directly linked to business performance.
What kind of things are they doing?
Financial inclusion initiatives, bringing more people into the banking system, financial education, green loans for environmental projects, managing environmental risk in their lending, tracking social impact metrics. They threw out a big number, integrating over 6 million Peruvians into the financial system since 2020.
6 million. Wow. Okay, so operationally, the picture looks like solid core results, improving loan quality thanks to the economy and their own actions, stable margins helped by cheap funding, growing income from fees and insurance, and ongoing investment in digital and sustainability.
That really sums up the key operational points from their discussion.
Okay, let's slice it another way. How did the individual business units perform? Starting with BCP, their main big universal bank.
BCP had a very strong quarter, reported a quarterly ROE of 27.1%.
27%, that's huge.
It is. Loan growth came from wholesale, large companies, and also consumer segments, including through Yape and BCP's own channels. NIM was resilient at 5.8%. And critically, NPLs, those bad loans, fell significantly, especially in wholesale and SME lending.
The cost of risk seemed particularly good at BCP, too.
It did, very low at 1.3%. They specifically linked this back to those cumulative improvements they've made since late 2023 in how they assess risk and underwrite loans. That, plus the better economy and some one-off technical factors like model recalibrations, meant they needed to set aside less for potential losses.
Okay. And Yape, the digital platform everyone talks about, what's new there?
Still growing like crazy, adding over 500,000 new active users every quarter. They're now past 14 million total users.
Wow. Are people using it a lot?
Yeah, engagement's high. The average user is doing over 52 transactions a month, using more than 2.5 different features on the app.
So the activity is there. Is it translating into revenue yet?
Yes, increasingly so. Yape actually contributed 4.8% of Credicorp's total risk-adjusted revenues this quarter.
Okay, nearly 5%.
And they highlighted that the gap between revenue per user and cost per user is widening. That's a good sign for profitability down the line. Payments are still the biggest piece, 56% of Yape's revenue. Things like bill pay, QR codes, online checkout are driving that.
And what about lending through AP? That seemed like a big push.
It is. Lending revenue is now 13% of AP's total. They had this big ambition, get 5 million Yape users to take out a loan.
How's that go?
They noted a real acceleration in what they call multi-installment loans. So loans paid back over time, not just one lump sum. Those now make up 50% of Yape's outstanding loan balances. That's up from just 25% at the start of 2024.
And they like those multi-installment loans.
Yes, they specifically said they have better asset quality, fewer defaults compared to the single payment loans they used to focus on more.
Is YAPE lending to small businesses much yet?
Not really, not yet. The main focus right now is still individual lending, SME lending. That's a future ambition. They need to sort of refine the product and processes first. But they see potential, noting lots of YP users are small business owners, and they think they have the data to eventually build something good for them.
Makes sense. Okay, shifting to Mabanko, that's their microfinance business in Peru, right? Lending to tiny businesses, individuals.
Correct. Mabanko Peru kept up steady profitability, mid-teens ROE. Asset quality got stronger there too. They resumed loan growth, focusing on smaller loans that tend to have higher yields. The NPL ratio fell to 6.4%, which interestingly they said is now back in line with pre-pandemic levels.
How did they achieve that improvement?
A mix of things. Adjusting their origination standards, offering debt relief where appropriate, and just getting better at collections.
The cost of risk discussion from Mabanko sounded a bit more complicated.
Yeah, there was some nuance there. The reported cost of risk actually went up compared to the previous quarter, but that was mainly due to base effects, meaning last year's comparable quarter had some unusual one-time reversals of provisions, making that number look artificially low. If you compare year over year and strip out those old one-offs, they said the underlying risk is actually improving because the newer loans they're originating now with better standards are performing better.
Okay, so underlying trend is positive despite the headline number. Got it. And Mabanko Colombia, how's that doing?
Results improved there, even though the overall Colombian economy is still challenging. They put it down to focusing on efficiency and being disciplined about risk. They've started originating loans again there too, focusing on what they call lower risk vintages.
Right. Pacifico Insurance and pensions.
Core underwriting results, the profit from selling insurance, were strong. But the overall profitability, still decent at 19.3% ROE, got dinged by a couple of things.
Like what?
Credit downgrades in their investment portfolio hurt returns, and some specific factors in life insurance. They missed out on a government contract payment they got last year, and claims were higher in corporate health insurance. Consolidating a joint venture didn't really move the needle much this quarter.
Okay. And lastly, investment management and advisory.
Operating dynamics there were strong. Their internal profit measure was above expectations, 18.4% or 16.9% adjusted. They saw good growth in assets under management, AUM, up 12% quarter on quarter in US dollars, 20% year on year. Capital markets activity was also good. That was partly offset by lower income and wealth management as falling interest rates hit deposit revenues there.
Okay, so looking across all the segments, core banking strong, digital scaling up and driving revenue, microfinance improving, insurance solid on underwriting but facing some headwinds, investment management doing well, and risk management improvements seem to be a common thread helping quality.
Yeah, that's a really good summary of the segment performance story they presented.
All right, so that's the look back at Q1. Let's pivot now to the future. What's Credicorp's outlook for the rest of 2025? What guidance did they give analysts?
Well, first, on the macro front, they're sticking with their forecast for Peru's GDP growth, around 3% for the full year. That's assuming, though, that global recession risks don't get significantly worse.
Okay, 3% for Peru. What about their own loan growth?
They expect their total own book, looking at average daily balances, to grow about 3% to 4.5% year over year for 2025.
Okay.
If you look at quarter-end balances and exclude that Bolivia accounting effect we talked about, the growth looks closer to 6% year over year. And they specifically said they expect this growth to accelerate through the rest of the year, driven particularly by retail banking and Mabanko.
So they see lending picking up pace. What about margins, NIM, and cost of risk?
For NIM, they're guiding to a range of 6.2% to 6.5% for the year. They think the shift towards more retail loans, which tend to have higher yields, will help support margins, even if overall interest rates drift down a bit.
And cost of risk, those potential loan losses.
They expect that to end up near the lower end of the range they previously gave. Now, Q1 was actually below their expectations, really low. They expect it to tick up a bit from here as they originate more of those riskier but more profitable retail loans. But here's the thing.
Yeah.
They kept the overall guidance range for cost of risk the same. Didn't lower it despite the very good Q1 and the reason they gave. Global economic uncertainty.
That theme again. Global uncertainty keeping them cautious on the outlook, even when current performance is strong. What about efficiency and other income streams?
Efficiency guidance for 2025 is maintained. They expect to stay within their target range for the cost-to-income ratio. Fee income, they expect that to grow in the low double digits. And insurance underwriting, expected to stay solid and relatively stable compared to last year.
Okay, now this really jumped out from the call. They reported that strong 20.3% headline ROE and even the operating ROE was 18.4% in Q1. Yet they're keeping their full-year ROE guidance steady at around 17.5%. That feels, well, quite conservative after such a strong start.
It absolutely does.
Yeah.
And analysts really pushed them on this in the Q&A session.
I bet. What was the response?
Management was very clear. They explicitly said, time and again, the main reason they are not raising the full year guidance, despite Q1 beating expectations, despite their positive view on Peru's economy, is that global uncertainty.
Specifically, trade and recession risks.
Exactly. Trade tensions, potential global recession, those are the external factors they're worried could impact Peru's open, commodity-driven economy. That's what's holding back the guidance upgrade.
So the message isn't, we don't think we can keep performing well, or we're worried about Peru. It's specifically, we're being cautious because of external risks we can't control.
That's precisely the message they conveyed. They did add a caveat, though. If they get more clarity on the global picture down the road, a guidance revision upwards isn't off the table.
Okay. And what about longer term? They had that ambition for sustainable ROE around 18% by 2026.
They touched on that too. Said they're reviewing that longer-term target right now. And they hinted that, given how well Peru's doing and their recent performance, they might actually be able to raise that 18% number. Expect an update in a few months, they said.
Interesting. So outlook summary. Positive on Peru, positive on their own execution. But official guidance is held back by a very watchful eye on those global risks.
That nails the core message from their forward-looking statements.
Okay, that covers the main presentation points. But the Q&A with analysts, as you mentioned, often adds important color. What were some key things that came out when analysts started asking questions?
Well, number one was definitely hammering on why guidance wasn't raised, and management just kept pointing back to the global situation. Trade, recession fears, commodity prices, external demand. They stressed it wasn't about Peru's domestic outlook. They see that as robust. It's all about the external factors.
Got it. Another thing was understanding the loan growth acceleration they expect later this year. Why the delay? Why didn't it happen sooner?
Yeah, good question. They explain there's often a lag after economic cycles before loan growth really kicks back in. Plus, right now, there's a lot of cash washing around the system, high liquidity, which means more people are paying off loans early, these prepayments.
Right.
But crucially, they sounded very confident. Said they are already seeing historically strong levels of new loan sales in recent months. They expect a big pickup in Q2 and Q3 as their improved risk systems get comfortable handling higher volumes again.
They also gave more detail on what drove that really low cost of risk in Q1.
Right. They reiterated it was multiple things. The good macro environment, some one-off factors, but importantly, the cumulative effect of all those improvements they've made to risk assessment and underwriting since late 2023.
So the changes they made are paying off.
Exactly. They said those enhancements mean they're now recognizing lower expected losses on certain types of loans. Now, they do expect cost of risk to drift up a bit as they start lending more in those riskier but more profitable retail segments again. But the idea is the better margins on those loans will more than compensate, leading to a net positive impact on risk-adjusted profits.
Okay. What about interest rate sensitivity? If rates fall, how much does it hurt their margins?
They gave an estimate. If rates everywhere fell by 100 basis points or 1 percentage point, they think their NIM would drop by about 17 basis points over 2025. And interestingly, almost all of that, like 16 basis points, would come from their US dollar loans and deposits. They don't expect much impact from local Peruvian currency rates changing.
Interesting detail. And despite all the political headlines you sometimes see from Peru, management sounded pretty unfazed.
They did. Remarkably calm, actually. Acknowledged the noise, the recent instability, but expressed confidence that the underlying macroeconomic situation is solid and likely to continue that way. Their views seem to be. The politics are messy, but it's not expected to derail the strong economic performance they see coming.
Okay. And lastly, any more specifics on Yape's lending strategy that came out in the Q&A?
Yes, they confirmed again it. Main focus right now is individuals. SME lending is definitely on the roadmap, but later. They need to get the individual product right first. And they re-emphasize that shift towards multi-installment loans, saying they plan to keep pushing that product type because their data shows it simply has better asset quality.
Okay, so the Q&A really underscored management's confidence in the domestic story, their own execution, while reinforcing that global uncertainty is the main reason for the cautious official guidance.
That captures the essence of the Q&A session perfectly.
All right, let's try and tie all this together. What are the absolute key takeaways, the core insights for you, the listener, to really focus on from this deep dive?
I think the strongest, most interesting takeaway is that dynamic we keep coming back to. The interplay between Peru's genuinely improving domestic economy, which sounds quite strong, and this persistent, maybe indirect threat from global uncertainty.
And how is Credicorp positioned within that dynamic?
Well, their Q1 results, especially that 18.4% operating ROE, show they're clearly capturing the benefits of that domestic recovery.
Right.
They're also reaping rewards from strategic moves, investing in digital like YNPE, and really improving their risk management. That's leading to better loan quality, lower costs. The insight here is their execution seems solid.
But the guidance acts as a warning sign about those external factors.
Exactly. That cautious guidance sticking to 17.5% ROE for the year, despite the great start, is a direct reminder. Even a strong domestic story like Peru's isn't immune to potential external shocks. Trade tensions, global slowdowns, they could hit an open, commodity-reliant economy. So the insight is, global risk matters. It's influencing their official outlook.
So looking ahead, what are the key things for us to watch?
I'd say two main things. First, watch their execution on ramping up that retail and microfinance lending in the next couple of quarters. Can they deliver on that expected acceleration? That's key to hitting growth targets.
Okay.
And
Second, keep an eye on those global risks. Do trade tensions ease or escalate? Does a global recession start looking more likely? Do commodity prices hold up? Whether these external factors stay contained or start to bite will really determine if Credicorp outperforms their cautious guidance or just meets it.
Okay, this brings us to our "This is not financial advices" segment. Let's be absolutely clear. Everything we've discussed is based only on the information shared during Credicorp's earnings call. This is not investment advice, not a recommendation to buy, sell, hold anything. It's purely a thought experiment based on the source material.
Absolutely. Crucial disclaimer. This is just about exploring the implications of what was said on the call, nothing more. Right. Disclaimer firmly noted. So, based purely on this earnings call, The company sounds really positive about Peru's recovery and their own operational improvements. You see it in that 18.4% Q1 operating ROE, the talk of loan growth accelerating.
Right. Strong internal picture.
But their official guidance for the full year is explicitly held back. And the reason given repeatedly is those external global fears, trade wars, recession risk, commodity impacts.
They're essentially saying, things look great here, we're executing well, but the world out there is iffy, so we're building that caution into our forecast.
Okay, so here's the outrageous but plausible thought experiment derived only from this call's content. What if those global fears that are tempering the guidance, what if they turn out to be overblown? What if trade tensions don't worsen, or there's no major global recession, or the impact on Peru just isn't as bad as the company is currently factoring in?
Okay, in that hypothetical scenario.
Yeah. Then the domestic strength and the company's execution, the stuff that produced that 18.4% operating ROE in Q1 might actually be a better guide to their real full-year potential than the more cautious 17.5% guidance, which is weighed down by those external worries they highlighted.
Right. So the speculative idea is essentially betting that Credicorp could beat its 17.5% ROE guidance for the year.
Exactly. It feels outrageous because you're essentially saying management's caution might be excessive. You're betting against the impact of those global risks they themselves flagged.
Right.
But it feels plausible because the strong domestic economy they described, their own reported execution gains, the improving asset quality, that actual strong Q1 result, they all suggest higher profitability is possible if those external headwinds don't fully materialize or are less severe than feared.
So it's a perspective that sees the guidance caution as being driven primarily by external uncontrollable factors that might not play out as negatively as assumed. It doesn't necessarily contradict their positive view of Peru or their own capabilities as expressed on the call.
Again, just a thought experiment, based only on this call, not financial advice.
Absolutely essential to keep that distinction crystal clear.
Okay, so wrapping up our deep dive into Credicorp's Q1 2025 earnings call. The big story is this company successfully riding a strong domestic recovery wave in Peru,
while keeping a very cautious eye on genuinely uncertain global waters.
They showed solid operational results, improving fundamentals in Q1.
But their official outlook remains conservative, explicitly tempered by those potential external headwinds they discussed.
Which leaves you, the listener, with a key question to ponder. Will the strength of Peru's internal recovery and Credicorp's execution prove powerful enough to overcome potential global challenges and maybe even beat guidance? Or will those external factors ultimately keep the story contained, just as the company currently forecasts?
Something to think about as you process the information from the call and continue your own exploration.
That's all for this deep dive from TalkTickers. We hope this gave you a much clearer picture of the key insights and dynamics discussed on the Credicorp call.